How to turn 100K into 1 million without stocks or real estate. You probably think the only way to grow your money is to dump it in stocks and wait, get rich with Ripple, or start managing OnlyFans models. But I turned 100K into over $1 million without touching any of those. No stocks, no rental headaches, and no wait 40 years to cash out your retirement program. It's all nonsense. So stick around because I'm about to walk you through the exact strategies I use to multiply my capital without relying on financial advisors, Wall Street, or gambling in crypto. What's up everyone? Ben Oberg back with another video. I'm gonna preface this. What the heck do I know? I didn't go to college, I don't have a degree, my mommy and daddy didn't help me with any of this, and I started from nothing from the ground up and figured it out, okay? So what we're going to cover today is the hidden ways, the unknown ways to grow your capital and build your wealth. You don't need a financial advisor, okay? You shouldn't be excited earning 8, 9, 10, 11% a year. You shouldn't be excited about paying taxes. There's that saying that says there's two things that aren't avoidable, death and taxes. I don't think death is avoidable, but taxes certainly are, and we're gonna talk about that all in this video. Most people invest the slow way. They put their money in a retirement account, they invest in a 401k, and they hope inflation and taxes don't eat it all up before they're 65 years old. Now, I want to pattern interrupt for a second here and break down a couple philosophies that I just do not agree with, okay? If you are putting your money away for 40 years and waiting until you are 59 and a half before you can touch it, that doesn't make sense. If you're investing that slow, where you're only earning 8 or 9 or 10% for the next 3 or 4 decades, that doesn't make any sense. What we do not ever talk about is that inflation is historically 3% annually. If we look at the Biden administration, inflation was 7, 8, 9, 10%. So when you're growing at 7, 8, or 9% in your retirement account, and you have to pay high income taxes when you go collect it, and you have to wait 4 decades until you're 65 and have a $200 a month Viagra subscription because you can't keep your dick up, that makes no sense. You have no money left because it's been entirely lost to taxes and inflation by the time you go collect. So one of the things you have to realize is that if you're not making 15, 20, 25% per year, and if you're not able to use that to go buy more cash flow and go build more wealth, then you're gonna stay broke and you're gonna do exactly what we have been taught to do. Go to school, get a job, get a retirement account, buy a motorhome, and travel around with Lois or Gladys or whatever your boomer wife's name is until you die in hospice. And that just doesn't work for me. It shouldn't work for you either. So here's what we're gonna do instead. And one more thing, let's talk about stocks for a second. They're volatile. Real estate requires massive capital, and 401ks, they're heavily taxed and locked up. I wanted a system that gave me control, cash flow, and could compound, not just paper gains. That's why I started doing something that I'm gonna talk about today. It's called the infinite capital formula. And this is not a new concept, okay? Bank of America, Wells Fargo, and even Chase are newer than the strategy that I'm about to teach you, okay? This strategy has been around since the 1800s. Legendary capitalists have used it, and you can use it today, and you can use it even better. So what I do is I do not keep my money in a savings account, not even a high yield savings account, because you pay taxes on the dividends that high yield savings pays. Okay? What I do is I keep my money, okay, and please do not be a hater here because you need to understand this. I keep my money in a high early cash value, dividend paying, whole life insurance policy, okay? And before you go, oh, life insurance is a scam, Dave Ramsey says invest in term and buy the difference. By the way, he owns a term life insurance company, so he would say that, okay? Before you start going, insurance is a scam, because it usually is, understand that 95% of insurance policies sold in the United States are not the one that I use. Okay? I use a whole life policy that is the same institutional grade policy that the banks buy, okay? And this gives me a couple things. I get a guaranteed return of 4% annually, and I get a dividend that has never been lower since the Vietnam War, never been lower than 6%. It's actually 6.4% this year. So I make 10.4% on my money. It's insured. Okay? If you have the right policy provider, they actually have to keep in their bank account more than the cash value that's in your policy, or more than the death benefit in your policy. So without getting too heavy into the details here, it means that it's fully insured, better than the FDIC, okay? So I make, step one, I fund this whole life policy, and I make over 10% on my money every year, and I compound it. So I don't pay myself out of it. I let it grow and grow and grow, and I recycle the profit and I put it back into the policy. And then the second step that I do is I get a line of credit against it, okay? This is very, very strategic, because a lot of people that do this, they get a different type of policy and they borrow directly out of the cash value, so it stops the growth. So what I do instead is look at it this way. I got $10,000 of cash value in here. It's gonna be worth 11 the next year. It's gonna be worth 12,100 the next year, and so on and so on. And I've got a line of credit against it. So as the cash value grows, line of credit increases. And I keep doing this. And the third step, after I've gotten that line of credit, I buy cash flow. I go into high cash flow yielding hard assets that are tax friendly. In layman's terms, oil and real estate. Now, I don't want to be a landlord, and if you're like me, you're busy, you have a full-time job, you're a business owner, you have shit to do. You want to go to the gym, you want to hang out with your girlfriend or wife or kids or like whatever the heck, and you don't want to make a job out of it. So I invest in passive real estate funds that pay me cash flow. Now, I'm already making 10% here in the policy, but then I look for things that do at least 20% in annual returns, and more often than not, higher. And so that way I'm making 30%, 30%, 30%, 30%. I don't have an advisor that's charging me fees, and I'm in very tax-friendly assets. So the worst I can do after inflation is still 25, 30% or more. And that's what you need to be doing, so you're not waiting until you're at 65 and your dick's now shriveled up and your balls have literally gone inside your rectum and you can't even see them anymore. You don't want to wait till then. You want to be able to have time and have your investments in your portfolio work for you so you can go do the shit that you love. Retirement is a scam. And in the description, I'm gonna include some resources for you to know like where to get this and who to get it from, because you don't wanna work with every plain Jane advisor. 99% of them are idiots, don't know what they're talking about. Most argue with me that my policy doesn't exist, but it does, okay? There's only a couple dozen advisors in the entire US that can provide them to you, and I'm gonna talk about that in a little bit here. So you get the policy, get the line of credit, you buy cash flow, but here's why it's called the infinite capital formula. You're able to repeat the process. So let's just say I've got $100,000 stacked up in my life policy. I've got that $100,000 line of credit. I can go buy a duplex, for example, all right? And that duplex, I'm gonna pay cash for with that line of credit. I put tenants in there, they start paying me monthly rent. I go to the bank, I refi that property, all right? They give me a loan against it, all right? My tenant's paying me $1,000 a month on one side, other tenant's paying me $1,000 a month. My payment on it is $1,200 a month. I'm making $800 a month in positive cash flow. I use the loan the bank gives me to pay the line of credit back. Now my line of credit is freed up again. I can go repeat the process. So now I have tenants paying the mortgage on the property. I'm pocketing the rest. I can go buy another piece of real estate and understand that every year this real estate's gonna go up in value and rent is gonna increase. So as I build my real estate portfolio, I can repeat that process, and I have no money in the deal. You can do that. Or you can just go directly into passive funds, which is another thing that I like to do, where you're going into apartment complexes that other people manage. You're giving them some capital, and in exchange, they're paying you a portion of the cash flow. And that's why I look for those 20, 25% annualized returns there. So I'm making 10 in my policy, 20 to 25 there, making 30 to 35% in annual returns. So that's all you do. You get the policy, you get the line of credit, you buy the cash flow, you repeat the process, you get all your money out of the deal. Okay, now I want to take a break here for a second and answer your questions. Let me know in the comments what your questions are. If you have any concerns, if you feel like you've been told something else, drop it in the comments. I want to clear it up for you. And if you're brand new to the channel, consider subscribing, because I'm dropping content like this every single week. I put shorts up daily as much as I can so you guys can learn all of these concepts. And as a matter of fact, I have an entire community where I can actually offer you a 7-day free trial if you want to participate in it, teaching you all of these strategies, partnering you with my multimillionaire and billionaire investment partners, yes, billionaires that you can work directly with, and we meet you right where you're at along your investing journey. You don't have to be a millionaire or a billionaire to work with us. You could be somebody that just has a few $100s a month of capital to deploy every single month. You could be somebody earning hundreds of thousands of dollars a year or millions, anywhere in between. We work with you regardless of what walk of life you're in. And in the description, I've included a link to the Capitalist Network so you can get access to a 7-day free trial and just simply start to learn. There's no obligation. If you don't like it, leave, because we don't want people in there anyways that don't like it, but at least learn so you can start actually implementing this, because these are not the mainstream deals open to the public. You won't find this advertised. This is exposing you to this close network of multimillionaires and billionaires that I have spent tons of time, money, and energy to get into my circle, and giving you direct access to them. So now, moving on, a couple other assets I want to talk about that I really like. One of them is oil and gas. And the reason is you get huge tax deductions. See, when you invest in oil, and I'm not talking about a stock, I'm not talking about a mutual fund, but if you actually invest directly into an oil well, I do what's called horizontal oil drilling. So I've got an operator, a landman like that show, original landman, OG landman, that's been drilling oil and gas longer than I've been alive. Since before I was a sperm, since before my parents even, I think, knew each other, homie's been drilling oil and gas, okay? And I go into horizontal wells. The reason I go into horizontal is if you think about an oil pocket, reserves are typically these giant pools that are like 20,000 feet below the surface of the earth, at least in the United States. Other areas like Saudi Arabia, they're shallow. That's why Saudi Arabia discovered oil and just boom, they built fancy cities, and like a broke person makes $500,000 a year. It's crazy, okay? So I go into these oil wells where there's this giant pool. Now, if you just have a vertical well, you're only gonna get out what's immediately beneath you. If you have a horizontal well, you can go entirely across that play. That's like an oil term. You can go entirely across that play, that oil play, all right? And so there'll be dozens of wells that are all around this big oil pocket, and then they get tapped into and connected horizontally, and I go into investment funds where I'm getting a portion of the cash flow that all of those different oil wells produce. And they pump out oil and they pump out natural gas. Now, the reason it's such a good opportunity right now is because AI actually is putting a huge strain on our power grid, and the green energy can't keep up with it. You cannot run a data center that has a huge demand from AI that's only going to continue to increase off of solar panels when there's no sun, or off of wind when there's no wind. So oil and gas industry are only going to continue to boom more and more and more. And oil and gas are more of a strategic political play for countries than a solar field is, or than a wind farm is, okay? These are used as geopolitical negotiations with different countries. So oil and gas will always be that way. And if you look at the real estate crash of '08, or if you look at areas where certain assets go down, real estate plummeted in value in '08, or like our dollar is heavily inflated in the last few years, you see gold and silver breaking records, or you saw oil and gas immensely go up. It's because of things like this. So the opportunity is there with oil and gas right now, and it will continue to be for the next several decades, but you also have heavy tax savings. So when we look at participating in an oil and gas well, you can write off as high as 80 to 85% of the investment capital in the year you invest against your earned income. Which means if you put, for example, $50,000 into an oil and gas well in 2025, you'd be able to write off, let's just say 80% of that. Your tax basis would receive a $40,000 deduction. Here's what that means in ABC terms. If you're making $100,000 a year and you put $50,000 into an oil well, for example, and you get an 80% deduction, that means that your tax basis lowers to $60,000 rather than $100,000. So rather than paying income taxes on $100,000, you're paying income taxes on $60,000, right? Then the cash flow, oil wells pay you cash flow. You have something called tangible drilling costs, which are depreciated over a 5 to 7 year period of time against the cash flow. And then you have something called the depletion allowance. The depletion allowance means that for every dollar you earn in cash flow, you can only be taxed on 85 cents. Then you insert the tangible drilling costs and you have an even lower tax basis. Then these oil wells that I participate in typically have large exits because you sell the future production to a larger oil company for a big multiplier. So you get a big payday, but a lot of people don't realize that that payday is a 1031 event. You can put the funds into another oil deal and defer the taxes just like you can in real estate. Now, I'm gonna break down a couple other investments and assets I really love. I suggest you take out a pen and paper. I suggest you listen very closely. I suggest you even rewind because I'm just going to fact drop so many things right now. You're seeing behind me a bunch of cars. I love cars, I love classics, I love exotic cars. Now, when you're in business, a lot of people buy those G-Wagons or vehicles that weigh over 6,000 pounds for business use because you can depreciate a large amount of the purchase price in the first year you buy that vehicle. So lot of people buy these G-Wagons that are $200,000 vehicles. You used to get 100% depreciation. Now it's closer to like 60%. It might be going back up, but the point is, if you've got $200,000 in earned income, and then you go drop money on a G-Wagon, whether you pay cash or finance, you can write off up to $120,000 of that vehicle in the year you buy it, thus taking your tax basis down to $80,000 instead of $200,000. What a lot of people don't realize though, is that you can also depreciate vehicles that don't weigh 6,000 pounds. To the extent you use them for business, you can get a lot of other write-offs too, should you choose to take one or the other. You can write off mileage, you can write off maintenance costs, things like that. I use the GT3 RS for business all the time, conducting meetings. It has my advertisements on it, has a link to my website, has a link to my Instagram. I use that predominantly for business. So I love looking at exotic cars or cars in general for business use so you can write off your taxes, but I also invest in cars as appreciating assets. My GT3 RS, I've put literally 15,000 miles on it, and I can sell it right now today for more than I bought it for a couple years ago. So I look at certain vehicles to invest in as appreciating assets while taking advantage of the tax deductions the IRS gives you, because the IRS is literally saying, hey, this asset is going down in value, even though it's not, but I'm allowed to drop my taxes on my earned income because of the laws they allow me to leverage. And I'm gonna give you one last one. This is what we would refer to as a non-yielding hard asset, gold and silver. Since the beginning of time, gold and silver has always been seen as a store of value. And when paper is eating shit and dying like the United States dollar, world reserve banks are dumping money into gold and silver at record-breaking numbers like they never have been before. Literally since 2022, Federal Reserve banks have bought more gold than any other time in history. It's because of so much geopolitical uncertainty. It's because of entities that exist like BRICS that do not want to use the US dollar anymore, having to look at going into hard assets that hedge inflation. Gold and silver. If we go back to the beginning of time, since like Jesus days, I guess that's not the beginning of time, but the point is the ratio of silver to gold was always around 16:1. And in 1792, you had what was called the Monetary Coinage Act, and it regulated the ratio of silver to gold at 15:1. And then in 1834, that ratio changed to 16:1. And only in the last 50 years or so has that ratio of silver to gold gone way out of proportion, where an ounce of gold is a little over $3,000, an ounce of silver is about 34, 35 bucks. That ratio is more like 1 to 100 right now, which means silver is immensely undervalued or gold is immensely overvalued. But nonetheless, governments are going into it. And if you literally look at 2008, gold went immensely up, 24, 25%. If you look at the last couple years, gold has literally doubled in value. If you look at silver in the last 18 months, it's gone up 50, 60%. So these non-yielding hard assets are literally wealth. They are money. Paper is not. I don't keep paper. I keep gold and silver. I stack it. And another reason I stack it is because I have a line of credit against it. So I can use it yet again, just like my whole life policy, to be my own bank and repeat this process of having that line of credit, buying cash flowing assets, getting all my money out of the deal, and repeating the process. That is how I turned 100,000 into over $1 million, not by saving harder, but by thinking like a capitalist, not a consumer. Guys, if you've loved this video, make sure again, smash that like button, subscribe, and I have included some resources for you in the description to start learning how to do this for yourselves, including your 7-day free trial to the Capitalist Network. Appreciate you guys, and I'll see you in the next video.